know the retailers have been slammed this week and wake up with a phenomenal run. But how about a real estate investment trust that owns a very particular kind of retail property? Let me introduce you to Brixmor Property Group, BRX, the largest wholly owned grocery store anchored shopping center real estate investment trust in the U.S. These guys have 521 shopping centers across the country. 71% of these are anchored by a grocery store tenant. What do I mean by anchored? Okay, there's no doubt that you've seen this in your day-to-day life. Think about a shopping center with a big supermarket, maybe a Kroger, an A&P, even a Walmart, and then a bunch of smaller stores that are built around that supermarket. Basically, Brixmor will take a shopping center, then try to bring in a higher quality grocery store so that they can also upgrade the other tenants. They like this business because supermarkets are essentially the one part of retail that's completely immunized against e-commerce. In other words, most of Brixmor's tenants can't be Amazon. Plus, the company's latest quarter was solid. Stock sports a beautiful 3.5% yield. Now, Brixmor was spun off by Blackstone in 2013. Blackstone still owns a majority of the company, although there have been a bunch of secondaries where Blackstone has sold stock. In fact, Brixmor just priced 22.5 million shares, $26.38. Early at $26.38 earlier this week. So look, they could still be unloading some of their position, but they've done it very shrewdly. Does the stock make sense at these levels? Let's take a closer look with Michael Carroll. He's the CEO of Brixmor Property Group. I'm telling you, this is a very exciting real estate investment trust. Learn more about his company and his prospects. Mr. Carroll, welcome to Mad Money.
Thank you, Jim.
Thank you. I've got to tell you, when I looked at it, I was going over with my research associate on this. I have to admit that of the real estate investment trusts that I've seen, 93% e-commerce defensive customers. And isn't that what you really need now if you're in your business?
It is. And you mentioned the grocery anchored part of it. We love that. We love that. It's non-cyclical, non-seasonal, consistent traffic flow. And there's not been an internet model that's figured it out.
In the same time, no one seems to be building what you own.
It's the beauty of our business today. We have a great tailwind. There is no new supply, no new construction coming on. We've gone from an industry that used to deliver 200 million square feet of shopping center space a year. In the fourth quarter, it was less than 2 million square feet of shopping center space delivered. So it's given us real pricing power.
Okay, well, how is that, though? Just speaking macro for a second. Is it because banks are tight? Is it because there's a couple of you have shown how you've had to upgrade for some weaker tenants? Yeah. Why haven't more places been built? We're a growing country.
Lending is part of it. We are a growing country, and that's a part of it, but lending is a big part of it. I think just retailer demand now, because they are investing into an online platform, is just focus on core stores and try to make those stores better. And so it's been a nice environment for us to continue to upgrade and operate our business in.
One of the things I loved is that a lot of the retailers that we recommend routinely on the show, because we know that they can't be Amazon, you've got a relationship with Ross, which is our favorite apparel, with Ulta, which is our favorite cosmetics. These are great tenants, aren't they?
Great tenants. We're TJ Maxx's largest landlord.
You know, $69.
Ross
we love
is great.
Those guys.
Look, it's off-price, and off-price doesn't work on the internet, right? They don't have 10,000 of these shirts in every size. It's a different model.
And at the same time, it seems like Walmart's neighborhood stores might be right for you, right?
We've been doing a lot of business with them, and they've been rolling out, and that's given us a great opportunity to upgrade.
They could put up 1,000 of those.
Yeah,
that could be great for you.
Absolutely. We started in California. We've done them in Denver, Charlotte, all across the country. It's great.
Now, traditionally, when we have real estate investment trusts that are able to do what you do, and you've got still some space that you can lend, that you can lease at higher prices, we expect to try to have good distributions every year?
Yes. Yep.
That's been your philosophy, right?
Last year, we increased the dividend 12.5%. So it is a big component of our business. We've paid roughly, with this most recent dividend, over $1 in dividends since coming public 18 months ago. And so you add that into a $6 appreciation in stock price, it's a nice total return.
It's been terrific. Now, people will be listening at home. They'll say, well, wait a second, Jim. Kmart's not a good one. Office Depot, Best Buy, and I would say, well, Best Buy a little better than the others. But I would say that you've got the formula for all those kinds of companies.
Well, that's a great story, because those are leases that were made 15 years ago, below market rents.
Right.
We're increasing rents rapidly through the company. We've had 14 straight quarters now of revenue increases in the company. And just thinking about, last quarter as an example, we went from new leases signed versus prior 41% higher than what the prior lease was on a new lease.
And that's why it seems like by far you're the most profitable in your particular segment.
I think we have the best runway in the space. We have a good stable of below market leases. We're in a rising rent environment. And we've got a good format in the grocery anchored format that's allowing us to good pricing pressure to raise rents. But
you also have just a great, David Faber asked me this. He said, listen, you ask him if you see takeovers, consolidation in the industry, and whether the retail industry is robust enough to continue to support growth in the country.
I think it is. Look, there's always going to be consolidation. Retail is very dynamic, but where supply is in check, that's really the key, that there is not a lot of new supply coming online, and we can absorb. And look, in our space, we're very flexible. There's always new uses created. Think about all the quick service restaurants that are out there.
I saw that
today.
You've got a lot of them. We like them, and a Chipotle comes in, and
absolutely.
then I always thought it was funny,
Burger is somebody,
right?
yep.
And then you, of course, the obligatory Petco, which we know isn't going to be Amazon.
Right.
So you've got all the companies that we focus on, because you've got all the ones that we will not talk about because if they're going to be Amazon, because it's just the destruction. It's a disruptive force, and you're the answer to it.
Absolutely. Think about our business. It's necessities. It's food, value, discount. Those are items that are very defensive.
It's a great formula.
Yep.
Okay, I hope you like the story. It's Mike Carroll, CEO of Brixmor Properties. I love the story. I was not familiar with it until we booked the guest, and sometimes you just learn a ton. A lot of great documents to learn from. Stick with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.